Good morning and welcome to Charting the Markets on Wednesday, the 4th of October. Yesterday evening in the US, the House of Representatives Speaker Kevin McCarthy lost a no confidence vote, and it's the first time that this has happened in US history, and basically it led to the culmination of a right-wing revolt, which could potentially paralyze the upper echelons of the US government. And this has led to risk-off sentiment alongside better than expected JOLTS numbers, so job openings numbers in the US, which showed that the US labor market remains really, really tight. And basically on that risk-off sentiment, equity markets have continued to slide very sharply globally. And we saw that earlier this morning in Asia as well. If you look at the Nikkei 225, we can see here that we are now trading below the 200-day simple moving average here at 30,690. And this is the first time this has happened since March of this year. So you can see here a very sharp acceleration to the downside taking place for the Nikkei 225, and it trading at levels last seen in mid-May of this year. And the next downside target, potentially, if we were to fall through this morning's low at 30,270, would be the 50% retracement of the entire advance that we've seen since the early January lows. And that 50% retracement comes in at 29,720. So short term, we look really bearish with regards to the Nikkei 225. And yesterday's potential intervention by the Bank of Japan, it hasn't really made a statement with regards to that. With regards to the Japanese yen, has also led to a weaker stock market in Japan. Now, in Europe, we can look at the FTSE 100. What we've seen here is basically the FTSE 100 dropping all the way earlier this morning to 7,431 on this daily financial bet. And here we have slid through the August to October uptrend line. And we're also trading below the orange line here at the moment, the 55-day simply moving average at 7,528. So all of this really being quite negative. So what are the potential downside targets? Well, we had the late May low at 7,433 as our downside target, which we hit this morning. So it's possible that we may actually revert to the upside. And if that is the case, what we need to see is not just a rise above the 55-day simply moving average here at 7,528, but also a rise above the breached uptrend line, which now, because of inverse polarity, is a resistance line. And today it comes in around 7,564. So a rise above there in the course of this week could potentially take us back to the red line here, the 200-day simply moving average at 7,650. But from a technical perspective, for the bulls to be back in control, what we really need to see is a rise and daily chart close above the last reaction high. That is to say, a high on the daily candlestick here, which is higher than the one to its left and to its right. And that was made on Friday of last week at 7,675. So basically what I'm saying is, provided we can overcome 7,675, we could be heading back up again and be bullish. But unless we do so, the bears are in control with regards to the FTSE 100. And if you look at the US markets, the story is quite similar here on the S&P 500. We have slipped earlier this morning in the overnight session below the red line, the 200-day simple moving average at 7,417, but currently are regaining some of these lost ground with regards to the S&P 500 as European equity markets are trying to stabilize across the board. Now, what is interesting here is that this whole area between the red line, the 200-day simple moving average, and the high seen back at the beginning and mid of May of this year, between 4,217 and 4,187, actually offers a very important support area. And that, combined with the fact that if you look at the latest lows we saw yesterday and today on the S&P 500, we see lower lows on the price chart, but down here we see higher lows on the relative strength index, the RSI. And when that happened, it is called positive divergence. And when it happens at major support, in most cases, it does lead to a reversal to the upside taking place. So I wouldn't be surprised if today we would actually have a positive finish to the day. Now, for the medium-term trend to become bullish, what we also need to see is a high and a daily chart close above Friday's high being made at 4,332. So that's the line in the sand. As long as we stay below there, there's a risk of further downside to be seen, even if short term we are bouncing back. But if we manage to take out over the next few days 4,332 on the S&P 500, then to me that would mean that this big ABC zigzag correction in terms of Elliott wave analysis has ended, where the C wave here, as you can see, from the 4,540 high down to today's low, is similar lengths to the A wave from 4,607 to 4,337. That distance here basically being projected from that high here to the downside. And now that we are bouncing off the 200-day simply moving average and this key support area, we could actually end this whole bearish phase, which started back in July of this year. But let's not jump the gun. Let's see what happens over the next few days. Short term, as I say, a bounce is likely to taking place today, but we need to take out the last reaction high, that is to say 4,332 Friday's high on the S&P 500 for us to be more bullish going forward. The US dollar, after having risen for 11 consecutive weeks in a row, basically is still on track to perhaps even this week have its 12th consecutive week of gains, I should say, as US yields have risen very sharply over the last few days on this thinking that the Fed is going to keep its rates higher for longer. And basically US yields on the 30 yield front yesterday and earlier this morning hit the 5% mark. And the 10-year yield rose all the way up to 4.88%. And that led to the US dollar remaining strong, but also to risk-off sentiment with regards to equity markets. And when you look at the inverse of the US dollar basket, you can see here euro dollar falling to 104.60. Now, what is interesting here from a technical perspective is that we have a similar pattern to the one we're seeing on the S&P 500 in that, A, we have retested key support taking us back to December of 2022 between 104.84 and 104.44. And we can also distinguish here positive divergence. So the latest price low we made on Tuesday was not confirmed by a lower reading of the RSI. Instead, the RSI has made a higher low compared to the low it saw at the end of September. And this is called positive divergence. And it points to at least a short-term counter movement to be seen over the next few days. But again, like we saw with the S&P 500, what we need to see is a rise above Friday's high. That is to say 106.17. Once we've taken that out, this whole decline we've seen since July of this year may actually be coming to an end. But we need to see that rise above Friday's high at 106.17 before we can make such a judgment call. And short term right now, we're holding at the support area, but if it were to be fallen through, then we would be heading down towards the next support level, and that is to say the late November low at 102.91. So that is another possibility if that current support level was not going to hold. Now, the same is happening here on cable, and you can see here cable, the British pound against the US dollar, also slid very sharply over the last few days, but dropped down to 120.37. I actually need to amend that low. And basically, we're bouncing off that level at the moment. And the interesting thing here is that we're also seeing positive divergence. You can see here a higher reading on the RSI accompanying the lower reading on the actual price chart of cable. And this is called positive divergence. And it does indicate that at least short term, we are likely to head back up again towards the September to October downtrend line at 122.06. But again, here for a major reversal to become more likely, what we need to see is a rise above Friday's high at 122.71. As soon as we see that, we could say with a pretty high confidence that a reversal might finally be taking shape to the upside for the British pound against the US dollar. So that would mean that the US dollar against a lot of other currencies is actually reversing to the downside. But let's also have a look at the Japanese yen. And what we can see here is what happened yesterday in the afternoon here for us, but in the middle of the night in Japan. And that is a 200+ pip drop on potential intervention by the Bank of Japan. Now, the Bank of Japan hasn't come out yet with a statement confirming that it did intervene, but it certainly looks like it. As soon as we rose above the psychological 150 yen mark, we suddenly dipped down all the way to 147.29 on the daily financial bet, as you can see here, and fell below this uptrend line, which has been in place since July of this year. Now, in order for this uptrend line to be valid, what we need to do is to redraw it, because we can't have any data going through it. So the current uptrend is now this one here. And yes, we are at the moment just consolidating below that 1-year high at 150.16. And you may remember that last year there was also intervention by the Bank of Japan. And you can see here we came off the October high at 151.94 and then had a very significant reversal to the downside take place. But we'll have to see whether something similar is happening with regards to dollar yen this time around. At the moment, the impact of the possible intervention hasn't been that great. Yes, we did dip down by about 250 pips or so, but then we rallied back above the 149 yen level, and we are oscillating around there and very low volatility trading at the moment. The higher US dollar has had a negative impact on a lot of commodities, but so have higher yields in the US, with the US 30-year bond yield rising to 5% earlier this morning, and the 10-year yield to 4.88% at one stage. And that obviously puts pressure on some commodities such as gold and silver. And we will look at these in a minute. But since we've got OPEC Plus out earlier this evening, that OPEC Plus meeting perhaps telling us that we could have more supply of oil coming through in the next few days. And technically, since we are now falling through the late September low at $87.85, which I've been talking about for the last week or so, it is possible that we will see a daily chart close below that $87.85 mark per barrel. If that were to be the case, for me, that would mean that we have actually topped out with regards to the oil price, and that we're heading back down again towards the August high at $84.39. Now, why is that the case? Well, simply because, as I mentioned since last week, what we've seen on this chart is negative divergence. Here we had a new 1-year high in the price of oil at $94.25, which was not confirmed by a lower reading of the relative strength index. You can see that this one here is slightly lower than the one at the middle of September. So we have a lower reading on the relative strength index, not confirming the new price high. And that, as I said and have been saying for the last few months, quite often leads to a reversal in the trend, or at least a consolidation against the uptrend. So far, we've seen the consolidation. But if we fall through and close today below $87.85, that is to say the late September low, it means that from a technical perspective, this top is also confirmed. And as I say, in that case, we could fall to $84.39 and perhaps even slide much further towards the orange line here, the 55-day simply moving average at $84.08, and perhaps even all the way down back towards the psychological $80 mark. But let's see where we close today. Let's see what OPEC Plus comes out with, and whether Saudi Arabia will continue its voluntary output cut until the end of the year. And at the moment, that is at 1 million barrels a month, I should say, excuse me. So interesting times ahead for the price of oil. But as I've been saying just now, the price of gold has declined very sharply. We've had basically here 7 consecutive days of falling prices with regards to gold, as investors go out of risky assets and invest in basically bond markets, because basically if you look at 5-year yields on the 30-year US bond and 4.88% on the 10-year yield, it might make sense to invest there instead of gold, for example. So you've seen this very sharp decline in the price of gold, taking us down to yesterday's low at $1,815 per troy ounce on this daily financial bet, just marginally above the February and March lows of this year between $1,810 and $1,805 per troy ounce. So this is a really key support with regards to the gold price. and we may find support in that area and stabilize over the next few days. And with regards to the silver price, the story is quite similar in that we've fallen through this key support area made up of the June to September lows between $22.30 and $22.12, and have fallen very rapidly to yesterday's low at $20.69. And here we're also trying to regain some of these losses and head back up again towards the 6th of March high at $21.30. But even if we were to rise above there, we've got some really, really good resistance now, basically between all of these lows we've seen since the middle of June. So between $22.12 and $22.30. So it's very unlikely that we will be able to break through that key resistance area, even if we were to bounce further in the next few days. But if we were to fall through the $20.69 low with regards to the silver price that we saw yesterday, we could be heading back down again towards the psychological $20 mark and also the March low at $19.19. So short term, yes, we might bounce back, but the trend is your friend, and that's still pointing lower. And that will remain the case as long as we stay below the 200-day simple moving average and also Friday's high at $23.56 up here. Now, last but not least, I'd like to also mention Arabica coffee, because what we're seeing here is also very interesting from a technical perspective, in that we are seeing some positive divergence once again. So we are seeing positive divergence with regards to equity indices at key support. We're seeing it across the FX spectrum with regards to a lot of crosses with the US dollar. We're seeing it with regards to commodities such as Arabica coffee. And you can see here that Friday's low at 14,550 was marginally below the low made in mid-August, but the reading on the relative strength index was a higher one, so positive divergence. So perhaps here the price of Arabica coffee could head back up again towards the orange line, the 55-day simply moving average of 15,531. But it does look to me as if we are basically bouncing off our near 9 months lows at the moment with regards to the coffee price as well. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, formerly known as Twitter. My handle is @AxelR_IG.